Dis shares tumbled on Friday after reporting disappointing fiscal second quarter results, with revenue and new Disney Plus subscribers coming up short and the company's theme parks business posting a fourth straight quarterly loss. Shares of the Dow component were down as much as 5.4% at session lows Friday morning, which would represent the stock's worst day since June 2020. Disney's in the middle of a recovery. I think what you're seeing in terms of the stock performance is, Disney over the last 12 to 15 months has essentially decoupled from its earnings, Lightshed Partners media analyst Rich Greenfield told Yahoo Finance on Friday. According to Greenfield, the weak Disney Plus subscriber additions were the key catalyst for Wall Street's negative reaction to the results. The streaming platform had been a major source of strength for the company over the course of the past year, with growth in Disney Plus compensating for declining traffic at Disney's lucrative theme parks. That streaming momentum, however, appeared to decelerate this year. The company added 8.7 million subscribers in the first 3 months of the year, bringing its total Disney Plus subscriber sum to 103.6 million. That was shy of the 110.3 million the street had been expecting, according to Bloomberg data. Investors are basically giving it credit for a full recovery from the pandemic from a theme park standpoint, and even from a movie standpoint. And so the stock has really risen over the last year primarily on one thing, which is investor excitement that Disney Plus can be the next Netflix, or that they can be a direct-to-consumer streaming success led by Disney Plus globally, Greenfield added. Even given Friday's drop, shares of Disney were still up more than 60% over the past 52 weeks, outperforming against the S&P 500's 46% gain over that time period. Shares of the entertainment giant have fallen about 5% for the year to date, however. This is really all about Disney Plus, Greenfield said. I think the question a lot of investors are going to be asking is, did the same pull forward we saw at Netflix, was there a lot of pull forward at Disney? And does that mean slower growth over the next 12 months? And I think that's why the stock is selling off here. It is just not the direct-to-consumer growth story that people were hoping for coming out of earnings. Like Disney, Netflix also posted weaker than expected subscriber growth in its latest quarter, suggesting consumers were already being lured away from at-home activities like streaming during the post-pandemic recovery. Netflix added only 3.98 million paid subscribers in its first quarter, or sharply below the 6.3 million expected, and guided below consensus estimates for current quarter streaming additions. Other analysts, however, encouraged investors not to focus narrowly on the second quarter slowdown in Disney Plus subscribers.